Hey guys, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter, coming to you from down here in Central Florida on a nice Tuesday afternoon. Now, we had hoped to have some new audio video stuff in place, maybe a little better sound this week, but we couldn't really make up our mind on a couple of the program options. There was a little foot dragging involved over the weekend. But we've made some decisions. We should have the stuff installed in time for next week's little broadcast. But for this week, you're stuck with just me and my palm tree pictures and what little bit of information we've got for you this week. Big news, of course. The Baltimore Orioles, 6-0, only undefeated team in baseball. We are pretty excited about that around here. The pitching staff has been okay so far as the starters. The bullpen's been fantastic. Zach Britton and Darren O'Day doing their usual great job, and the bats have just been on fire. Now tonight we're playing up in Boston. Really looking forward to this game. Microlight is getting his first start of the year. Now Mike came up last year to the big leagues, got off to a great start. Back part of the year, kind of slipped back a little bit. Wasn't quite as solid. Looked good in spring training. I saw him pitch against the Braves. He looked very sharp. Now, I got a special interest in Mike Wright, I have to tell you. It's a great article last week, and I shared it on my Facebook page and in my Twitter feed, which if you're not following, by the way, it's at Tim Melvin on Twitter, and it's just Tim Melvin on Facebook, and I do accept most friend requests. So feel free to follow me on either one of those two social media sites, but make sure you have a sense of humor, because in addition to business stuff, I get a little snarky from time to time, especially if I watch see what it does to me, watching anything even vaguely to do with the current election cycle. So anyway, there was a great article. Mike Wright, of course, was in the minor leagues, not making much money. As soon as they bought him up last year, he started getting that big league paycheck. It's like around $500,000 is the rookie minimum right now, as I recall, maybe a little bit less than that. But once he started getting that bigger paycheck, he started sending a big portion of it home. And he sent it home so his sister could quit her job to take care of their mother, who is suffering from a form of dementia, on a full-time basis. And he's just committed to helping his family deal with this difficult time in any way that he can. And he continues to send a huge chunk of his major league paycheck home. That's just a great story to me. A young guy, all the talent in the world apparently, whose family's going through some tough times, and he's doing what he can to help them out. We hear so many of these young athletes coming up and just turning into less than quality people when they start receiving this big money. So I'm really hoping that Mike Wright goes out there and leads the Orioles to 7-0 against the dreaded, really disliked, usually described with foul language Boston Red Sox tonight. We beat them last night on a Chris Davis 3-run homer in the ninth. Hopefully, we can see some more fireworks tonight. Now, going on, of course, last night we had Alcoa, and it's going to kick off earnings season. This is the most ridiculous thing in the stock market. Everybody's going to sit around, and I want you to think about this. When you make an earnings play, as they're called, what you're doing is you're making a bet that your guess about some analyst fresh out of college, in a lot of cases, guess about the 3-month earnings of a corporation is better than somebody else's guess. It's the craziest thing, but tens of billions of dollars are going to be added and subtracted to company market caps over the next 4 or 5 weeks based on earnings-related trading, whether you missed or exceeded a 3-month estimate of business conditions. Worse, and that's bad enough, because a ton of money is going to get lost. If you're a retail trader, the worst thing that ever happens to you is that you make money on one of your first couple of earnings-related trades, whether it be stock or options, because that's not consistently going to be the case in your career. I know some professional option traders, before earnings season, that's where they make all their money. Their systems are designed to gain you, the retail trader. All the options that you'll see in earnings season on the more popular earnings plays are going to be mispriced just enough to pick your pocket and take you to the cleaners. You've got to get the guess right. You've got to get the market's reaction to the guess right. And that's just two very difficult things to do, each and of themselves. Doing it together on a regular basis to be a profitable earnings play trader is a daunting task, to say the least. But we're going to do it anyway. We do it every year. There's an absolute fascination. The newscasters will be on. They're breathlessly reporting these earnings misses and beats like they're the falling of the Berlin Wall. And in reality, folks, corporations last for decades. The little 3-month snapshot, I'm glad we get it. I do read them of companies that I'm involved with and that I'm interested in. It does have relevant information, but rarely does a decision come down to one 3-month slice of a corporation's life. It does happen. Occasionally there's a quarter where things get so bad or get so good that that's the driving force behind a decision to buy or sell. But I got to tell you, it's really, really rare for that to happen. The only thing that we look for in earnings season around here is occasionally there'll be a company that's on our watch list, stocks that we want to own at lower prices. They'll miss the always highly accurate Wall Street analyst estimates, and the price will fall to a discount to net asset value, allowing us to get involved at a great price. Doesn't happen that often, but when it does, we're happy to take advantage of it. I don't like the short-termism nature of earnings season-related trading. I think it's horrible, a horrible way to run a business. And in addition to the business and financial costs, there's social costs to this and economic costs. When companies are using their money to buy back stock and they're laying off employees and engaging in other sorts of financial engineering to come as close as possible or slightly exceed that highly anticipated quarterly earnings number, they're using shareholder cash that could have been paid back to me as a dividend instead of buying back stock at 25 times earnings to manage your corporate earnings and increase the value of your options. Not a game I like to see. Layoffs to meet the earnings number are just appalling to me, but they do happen all the time. It's a lot better uses for that corporate cash, guys. And when you're using it to buybacks to manage the number, you're taking money away from it. And there's just a Harvard study that showed this. Research and development, new products, jobs growth, and other things that are actually good for the economy and for society at large. So I detest short-term trading around earnings season, but it's going to happen. We'll see how it plays out. We've got the big banks later this week. You've got Wells Fargo, JP Morgan, Bank of America, and Citigroup. Everyone's going to be watching them closely to see if there's any big clue about the economy or the direction of the market. There's not. They're going to struggle. They've got problems. You know, we're seeing signs of a turn in the credit cycle. You should see higher loan loss provisions, which pull back from earnings. Some of the banks are going to continue to show signs of energy-related loan problems, so that's going to be an issue that they have to deal with. And of course, net interest margins are still at very historic lows. The core mortgage lending business has become very competitive, not much margin in it, and there's not huge corporate demand on the loan side either. And a lot of the riskier loans, the banks have gotten out of that business and left it to business development companies and private equity funds and those types of folks. So it's just going to be a tough quarter. We'll see how they all did on the trading side. Maybe that'll help make up for it. But since so much trading is foreign exchange and fixed income, unless they were just continually long the dollar, maybe that'll help a little bit. But I don't think there's going to be a big bump from trading to offset some of the other difficulties that the larger banks are facing right now. It's going to be a better story for my nice little small banks, I do believe. We're going to see some provisioning. Some banks, Texas, Oklahoma, we may see some oil-related provisioning. Not as much of that in the small banks as there is at the bigger banks. Even in the smaller Texas banks, by the way, a lot of them stepped back and just kind of avoided this go-round of the energy cycle. I'm really hoping Wall Street does the baby in the bathwater thing and just paints all Texas banks with a great big old energy brush, takes these prices down below book value where we can get involved. Because the fact of the matter is there's a lot more to Texas than just oil and gas. They've also got a booming agriculture sector. Tourism is big. Technology and biotechnology are big, particularly in and around the Austin area. So if we could get Texas banks at a discount to book value, we're going to be pretty happy about it because there are some great candidates that do not have a lot of exposure to energy lending. So it's going to be a very interesting earnings season. Be lots of silliness and craziness, wild moves in the stock prices. We're probably about it. We're not going to participate. Finding other things to do with our time than dealing with the day-to-day madness that is earnings play. trading, whether it's stocks or options, you're probably going to end up a net loser. There's some guys in New York and Chicago going to be very happy about your increased trading activity. So be aware. They're picking out a new car based on your trading around these earnings reports over the next several weeks. So I try to resist the temptation to get in on that game. Anyway, one of the activities we're going to do to continue to distract ourselves from all the noise that comes out of the TV, we do it with the Fed by taking a nap. But I can't Rip Van Winkle all of earnings season. If nothing else, I don't think my wife would allow it. So we're working on a couple projects. One in particular I'm fascinated by. It's the results are exciting. Doing the grunt work on this is very boring and time consuming, but it's keeping me busy and off the streets. We're looking over some of the leading activists and bank specialist returns. Now, we have the Stern AG report that shows the outperformance, and it's enormous. Okay, it's like 27% over and above the bank index during the activists holding period. What the study doesn't break down, and I'm really grateful to one of our subscribers who pointed out that it looked better than maybe it really was because they didn't tell us the holding period. So if you've got this massive 26% outperformance of the index, and it takes place over 2 to 3 years, you've still got a great return, but it's not the 40% return, the total return that's shown in the Stern AG study. That return takes place over 2 or 3 years is still a great return, but it's not as spectacular as the study made it look. I don't ever want to give the wrong impression or be overly enthusiastic in talking about the small banks. So what I'm doing is going back through and we're looking at the annualized returns of these bank stock activists from the minute they filed until they sold their position or the bank was taken over. Now we've done 5 of them so far. We've got a bunch more to do, hoping to get through and actually get to the 13G filings, which are non-activist filings by certain bank stock investors. That there's so many of those, and it's going to be a little harder to collect all the buy and sell information. So we're going to do that second. We're only dealing with 13Ds for now. Of the ones that we've done so far, no exaggeration here, guys. We've looked at several dozen filings among the 4 investors that where we've completed the study so far. We're not showing many losses over the last decade. It's like 2 or 3 of these activist positions that simply did not work out. There are a few more that didn't work out great. They're single-digit long-term returns so far. I think one of the ones was activists has owned the stock for a decade. It's averaged about 8%. That's better than the market, but it's not very exciting. However, on average, the results are more exciting than I could have hoped for, with a return range for the 4 activists from the high teens, 15-16% annual returns on these things during a period when the markets have returned just 3 or 4% a year since 2006, and the bank stock indexes are actually down. So substantially outperforming the market. The higher returns got up in the low to mid 20s so far. We're still crunching data, and we'll be sharing all the data with subscribers when the study's all done. I'll be naming names and telling you who the good guys and the bad guys are, so that'll be pretty interesting. But the results are great. Tracking bank stock activists is a worthwhile activity. Fortunately, it is time consuming. You've got to read the 13Ds every day. You got to know who all the players are. Now, of course, knowing their track record makes this even maybe a little bit more successful for us. But you've got me to do that for you because I'm doing it every day anyway. We send it out in the Banking on Profits monthly report. We get all the 13D filings that have occurred in the past month. Data's right at your fingertips, delivered right to your email box. And you will also be getting, if you're not already a subscriber to Banking on Profits Monthly, we are sending you a special offer along with a free copy of last month's issue so you can see exactly what's going on with the Banking on Profits Monthly. And hopefully you'll take advantage of it. I think it's a pretty good offer. They talked me into a little bigger discount than I like to give, but sign up, check it out. We've proven our point. We've been sending out the numbers on Twitter and Facebook. Following the 13D filings, the 13F filings, and the insider buying reports that we provide you each and every month in Banking on Profits Monthly has been a source of fantastic profits since we started this newsletter about 1.5 years ago. It can make you money. It doesn't cost you much money. One winning trade will pay for this thing uh, for the rest of your life, most likely, depending on how many shares that you buy. And so anyway, that's one of the things we're doing to keep us busy. One thing that we've noticed is we have been doing just a ton of studies. I've got a new one being written about tomorrow on real money, a nice little study that I wrote up, buying stocks that trade at very low multiples of book value and enterprise value to EBIT ratios, calling them double cheap, and they outperform the market. And they share a characteristic that every value study, just about every value study, there's one or two exceptions, but they're pretty rare. Every time we look at these stocks trading with value characteristics, there is a noticeable pattern over the last 17 years, which is how far back the database we're currently using goes. After a bear market, value-oriented stocks are just, they're rocket ships. The returns are unbelievable. They're huge. Running just a core concentrated, pure deep value portfolio. They're fantastic results. Lots of stocks around, usually well over 100, no matter how strict your criteria are. And we have safety criteria in there as well as price to book and EBIT ratios and things of that nature when we look at this stuff. So we're looking for quality deep value, not deep value that's on the way to the boneyard. But following a bear market, there's hundreds of them around. The returns are huge. Now, it sounded like Donald Trump there. As time goes on and you get 2-3 years away from the bottom of the bear market, stocks are recovering, markets are looking good, people are getting interested, maybe even a little bit excited. The returns start to drift back over the next year or two, closer to the market averages. Now that's okay because the markets are still rising. As time goes by, however, say 5 years out, maybe 6 in most cases, the value returns start to lag the overall market a little bit. And that is usually a sign that we're getting close to a market top. There's going to be very limited opportunities. Portfolios are holding lots of cash as the bull market takes prices higher. Not a lot of opportunities and not a lot of return from those opportunities. Now, if you look at it, guys, this sounds exactly like the last 2 years outside of the community bank stocks. Hasn't been a lot to buy. What was cheap is not attracting much institutional attention because everybody is, in the momos and the fangs and the things like that. So just taking that kind of anecdotal data, and that's also on the list of projects to work on. We're going to take all these studies together and try to look at how much market and cycle information we can extract from these studies about the performance of pure value investing. But there's definitely a lag as we get closer to a market top. All of this adds up right now to a great argument for holding a ton of cash. We do pretty much across the board in pretty much everything except the community bank portfolios, and I'm pretty happy about that. International in particular is now over 50% cash. We just don't like what we see outside the United States. There's no growth. Europe in particular has some massive geopolitical threats and problems. The economic drag from the immigration and refugee problem over there is starting to look like it's much bigger than anybody could have anticipated. And the expenses, of course, of providing security are just going to go up and eat holes in an already troubled governmental budget across much of the European Union. So we're watching that. Of course, you got a Brexit possibility coming up, which is going to create some market volatility as well. Just don't see a lot to do there. Not much in Asia that's attractively priced. And Latin America is, I think over a decade, I'm still, we've been in 2.5 years now. When Brazil finally does work out, we'll make a ton of money. It's going to take every bit of the decade I talked about when we first bought them. But right now, it's just a disaster. Probably going to be an impeachment down there, all sorts of accusations. Would not be surprised to see a coup, rioting, other developments of that nature in Brazil. Just not a lot of attractive places to put money to work. So I'm perfectly willing to kind of sit here and do nothing and wait for what looks like a more obvious opportunity in international stocks. We're not dissimilar here at home. We're about 36% cash in the regular deep value portfolio, just simply because there's not a lot of stuff to buy at this moment in time. So anyway, big week on the book front. We've got John Sandiford, new book out in the Prey series. Joseph Flynn, who has quickly turned into one of my favorite recreational reading authors, He's got a new book, the fourth in the John Paul Wolf series coming out. He plays a Bureau of Indian Affairs agent who's unusual to say the least. Great series, a lot of fun to read. We're getting into the spring and summer reading season, so maybe download the first three, head off to the beach, sit under the tree out back on the yard, and get a little reading done. They're a lot of fun, relaxing, a little bit of escapism, but it's better for you than TV, I think. So, then of course Tobias Carlisle. I have to say, by the Tobias is a Banking on Profits member, and he just put up a fantastic review of Banking on Profits. And I want to thank him for that. I want to urge you, if you're not already a subscriber, please go read this. Tobias points out we're doing good work in an underfollowed sector, and he was kind enough to say that I was the only one he would follow in investing in these small community banks. You need to be a part of this. We're sending you that special offer for the monthly edition. I hope you sign up for it and eventually become a member of the regular Banking on Profits service with the guided portfolio. So anyway, lots of good reading, lots of good baseball, lots of craziness surrounding the markets, and that's going to continue throughout the month of April and into early May as earnings season plays out. But we're going to do our level best to ignore it. If there's any opportunities, we'll take advantage of them, expecting good things with dividend increases, solid earnings, and more buybacks below book value from our portfolio of small banks. So we're looking forward to that this month as well. Anyway, that's about all I've got for you. I've got to go get some steaks on the grill, get ready to watch the Orioles and the Red Sox coming up here in a couple of hours on my little MLB TV app on my phone. If you're a baseball fan, it was only like $100 this year for every game all year long. So definitely a great value. So if you're a baseball fan, sign up for it. You can watch it on your computer. You can watch it at home anywhere you want to. So that's about all I've got. I will talk to you guys next week. Hopefully we're going to have some better audio-visual equipment in place, a little better presentation equipment. And for those of you that have been having a problem with the sound, it's actually been working fine for me coming back on the YouTube and the Market Fire recordings. But for those of you that have been having some problems, we're taking some steps to address that as well. So this is Tim Melvin coming to you from down here in Central Florida. And I'll talk to you guys next week.